ETFs that pay dividends can be a great way to increase your cash flow and spread out your investments. They make it easy to invest in a certain type of stock, in this case, stocks that pay dividends on a regular basis. You can add to your income with those dividends, as many retirees do. You can also put the dividends back into the fund to make the most of compound interest and grow your portfolio of investments. No matter what you choose, dividend-paying ETFs make it easy to add a wide range of investments to your portfolio all at once. I love me some dividends. I compiled a list of 5 US dividend ETFs with large market caps, arranged by yearly dividend yield. ETFs with high dividends may also have more risk. Always read the fine print and look into dividends that seem too good to be true. But hey, I'm just a guy on YouTube, so you don't need to take my advice. The Energy Select Sector SPDR Fund, ticker symbol XLE. XLE tries to match the returns of the Energy Select Sector Index and gives investors access to oil and gas companies. ExxonMobil Corporation, Chevron Corporation, and Schlumberger are some of the 23 companies that XLE owns. The expense ratio of XLE is roughly 0.1%, which means that if you invest $10,000, you will have to pay an annual fee of $10. One of my personal favorites, Schwab US Dividend Equity ETF, ticker symbol SCHD. The Dow Jones US Dividend 100 Index is what SCHD follows. Broadcom, Verizon, Texas Instruments are the top 3 holdings for SCHD. The expense ratio for SCHD is about 0.06%, which means that if you invest $10,000, you'll have to pay an annual fee of $6. Not bad, right? Vanguard High-Dividend Yield ETF, ticker symbol VYM. VYM is a large value ETF that follows the returns of the FTSE High Dividend Yield Index. Financials, healthcare, consumer staples, those are VYM's top 3 sectors. Johnson & Johnson, Exxon, JP Morgan, Chase are the top 3 stocks that it owns. The expense ratio of VYM is 0.06%, which means that if you invested $10,000, again, you'll have an annual fee of about $6. Vanguard Total International Stock ETF, ticker symbol VXUS. The goal of VXUS is to track the performance of the FTSE Global All CapEx US Index, which measures the investment return of stocks from countries other than the United States. Taiwan Semiconductor Manufacturing, Nestle, Tencent Holdings, those are VXUS's top 3 holdings. The expense ratio for VXUS is 0.07%, which means that if you invest $10,000, you'll pay around $7 annually. Vanguard FTSE Developed Markets ETF, ticker symbol VEA. VEA tries to match the way the FTSE Developed All CapEx US Index does with its investments. VEA gives investors access to stocks of big, medium, and small companies in Canada, Europe, and the Pacific. VEA owns 53% of stocks in Europe, 36% in the Pacific, and roughly 10% in North America. Nestle, ASML, Roche Holdings are the top 3 stocks it owns. The expense ratio for VEA is pretty low, it's 0.05%, which means that if you invested $10,000, you'll have about a $5 annual fee. And before we continue, don't forget to subscribe to the channel, hit that like button, turn the notification bell on to be notified every time a new video is uploaded. And if you liked this video, you should check out my other video where I talked about how to live off dividends with high yielding investments. All right, let's get back to the video. Can you live off ETF dividends? Good question. You can live off dividends from ETFs, but you'll need to plan carefully to make it happen. You'll have to find a good balance between how much money your investments make and how much you spend. The 4% rule can help you figure out how much you can take out of your savings each year. This means that you should try to take out about 4% of your savings each year. If you want to live off the money you get from ETF dividends, you'll need to take into account any money you get from Social Security, pensions, 401ks, IRAs, and any other sources. Then you can start to figure out how much you'll need from ETF dividends to sort of fill those gaps. Talking to a financial advisor might be a good idea if you're about to retire and want to understand how ETF dividends can help you live better. How to invest in dividend ETFs. Most of the time, dozens or even hundreds of dividend stocks are in a dividend ETF. That gives you instant diversification, which means your payout is more likely to be safe. Even if a few of the stocks in the fund cut their dividends, it won't have much of an effect on the dividend as a whole. When you buy a dividend investment, you should care most about how safe the payout is. Now here's how to think about buying a dividend stock ETF. First, find a dividend ETF with a wide range of investments. Most of the time you can find dividend ETFs by searching for them on a website of your broker. Robinhood, Public, whatever you use. A low-cost fund that picks dividend stocks from the S&P 500 stock index is probably the safest choice. That gives you a wide range of top US companies to choose from. Second, actually look into that ETF. Make sure the ETF is invested in stocks, also known as equities, and not bonds. You should also look at the following. The yield on dividends. This is how much a company gives out in dividends each year compared to the price of its shares. It's usually given as a percentage. 5-year yields, most of the time, the higher is better. Expense ratio. This is the annual fee for the ETF, which comes out of the money that you put into the fund. Look for an expense ratio that is less than 0.5%, but the lower it is, the better it is. Vanguard typically tends to be good. And then the stock size. Dividend ETFs can be used to buy shares in big, medium, or small companies, referred to as large caps, mid caps, small caps. Most of the time, large caps are the safest and small caps are the riskiest. And then the next thing to look at are assets under management. This is the market value of all the assets a fund is in charge of. The AUM gives you an idea of how big the fund is. Low AUM funds that promise high dividends, probably risky. So now you're ready to purchase the ETF. ETFs can be bought through an online broker, just like stocks. To get the most out of the dollar cost averaging, it's best to buy them often. And that's all. I hope you enjoy this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on that notification bell. And I will see you in the next video.